Stocks shed their earlier gains Tuesday after that weak data on consumer confidence came out. Well, stocks have had a pretty good run since the last time our guest came on. Max Wolff is an economist and managing member at Multivariate and joins me from his home in New York City. Welcome, Max. Now, when we last had you on, it was March 24th, and at that time we had a big rebound that day, and you thought that the rebound was unsustainable. Given the reaction that we've had from the market since then, Wall Street has recovered about 30%. Do you still think we're in a bear market rally, or are we in a sustainable up leg?
Yeah, so I'd liken the market at this point to a chicken running around looking very strong if you don't notice the one little missing piece, which would be the head. But yeah, it's running beautifully, it's fast, it's vigorous, and if you don't get hung up on the sort of blood fountain or the missing appendage up top, I guess it's a stunning thing to see, and it could go on for a while. Much like with a decapitated chicken, there's a rush of energy, and one doesn't know when it runs its course. It could be a while.
Well, today we had that disappointing number in consumer confidence tumbling to near 6-year low. U.S. exports collapsed. So at this point, we've had a string of weak economic data, and we're in the midst of earnings season. Um, so are you looking then for another big down leg in the markets, and how big?
It's kind of really hard to know. For us, this is an interesting stock take. For about 10 years, maybe a bit longer actually, approaching 12 years actually here, basically, the worse your investments were, you made money on the crazy risk you took until it blew up, and then the Federal Reserve paid you back, or increasingly now the Treasury pays you back. And so the smart thing to do is pick the most speculative, stupidest investment possible. And the market has done that, right? Because if I buy crazy stuff, then until the bottom drops out, I have a great party. And when the bottom drops out, the federal government makes me whole, right? And so it is the smart thing to do. The market is doing it. So that goes until you bankrupt the federal government, which is something we're pretty deep into right now. And then everything falls apart. But you might as well have as much cash when that occurs as possible. And I kind of feel like some folks in the market, the smarter participants, have figured this out, and it's being misinterpreted as an economic variable, which it no longer is, right? So it's in this self-referential world where speculators are our highest rescue priority as a nation. That's pretty clear. That's where the money goes. And so long as that's the story, you should actually pick the highest risk, highest return, because there is in effect no downside. I think the market's kind of doing that to some extent.
So do you think that is it what the money the policymakers are all allocated and the government is spending right now, running out of bullets that worries you? Is it the economy itself? Is it the earnings that are coming out?
So to add a little more granularity, yeah, those are great questions. To add a little more granularity, we're watching a stock market that's a story of indices where a small number of mega cap tech companies are the index, and tech is having a moment. I mean, a lot of what we thought would be the next 10 years of evolution has turned out to be the last 10 weeks of evolution. And if you're on the right side of that, that's pretty good. Okay. What makes me nervous about the market is they're buying up the tech names for basically eating the lunch of everybody else, but they're still buying everybody else too. Right. So in other words, we got an investment scenario that says the world is going to stop eating beef and start eating chicken, and I'm long beef and chicken. And however exciting that might be for the good days, it's a little bit problematic long term. Then the other thing is, I think the markets have gotten sort of some coalescence around the government will rescue us, which so far has been they'll try, and they don't care how much they spend to try. But one of the strange ironies is, I guess I don't share the outlook of all my colleagues that every government economic intervention is successful. Some are, but all are not. That's not the history. One. Two is I think we're going to look back with rather great disappointment around the PPP and some of these small business loans, which seem to have gone out willy-nilly to such struggling family businesses as chain restaurants and the Los Angeles Lakers. And when you put that much money out that fast, you're bound to make mistakes. But I mean, one has to wonder before that last moment of check writing, if somebody who was hitting the federal government for $10 billion worth of fees, which the banks did to distribute this money, wasn't checking. And we also have a huge risk here, which is that banks are simply giving money to whoever they know would default on them if they didn't get the loan. The problem with that is that you're giving money to the exact opposite group of people that we actually need to shore up the economy, right? Because the idea is you want to invest in the companies that need the help to get through the corona-related downturn, but are otherwise viable. They can keep their employees, that continue to pay state, local, and federal taxes, and that can continue to be pillars of the community. You don't want to just give people based on the probability of their near-term demise, right? That's sort of morally interesting, but it's not great lending practice. So I'm worried about that. And my bigger worry is the following: the market seems to be fixated on the notion of getting back from the quarantine. Certainly understand that, having been in quarantine with my family for weeks like everybody else. But the truth is, what we get back to isn't what we left. And I don't see any indication that we've priced that.
All right, so it looks like we may have a new normal, but thanks for pitching all those yellow flags for investors to consider, Max. Appreciate it. Our thanks
Thank you.
to Max Wolff of Multivariate. I'm Fred Katayama, and this is Reuters.